Alrighty guys, so in this video, we're going to be going through the Silver Bullet model, right? So that incorporates, I guess, two time frames. If you're trading the New York session, that's 10 to 11. If you're trading the London session, it's 3 to 4. We're going to back test both. And we'll do a couple of videos on this. But again, this might be the first time you guys have seen me. If you haven't followed me on TikTok, do that again because that's all free resource for you. And let's get straight into it. So what I'm going to do, I'm going to mark out the Silver Bullet range, right, which is from 10 to 11. And we're just going to kind of see if we can catch any trades looking back now from 10 o'clock to 11 o'clock. Now, there are things that rest around this time period called macros. Before and after every hour, so 10 minutes before and 10 minutes after, there's a macro, and that's sometimes provide you with an entry to go long or go short. So what we're looking at here, if I'm just kind of seeing the price action, what do? We rallied up and we created all these accumulation pockets, right? This is all liquidity here, right? Liquidity at these swing lows, liquidity. So all of that is liquidity. Now, on the 1 minute time frame here, it doesn't look like there's an imbalance. Notice that, like right here, there's no imbalance. What I'm curious to do is to go back in time, and we'll go through replay mode just to talk about it. Some people have asked me to do this as well. Let's go to the 2 minute time frame. Now, what do you see on the 2 minute time frame? A nice sell side imbalance. And let's kind of talk about this and let's mark this out. So if you're using a 2 minute imbalance, then always kind of mark that on the chart. That's what I do personally. 2 minute civvy. We did tap into it there. Have we had a market structure shift yet? Now, some people are going to say yes. Some people are going to say no. For me, that is enough displacement. And the more important thing for me is that we've closed with this candle below the halfway point of this wick and below the bodies. The bodies hold the volume, right? So the wicks just do the damage, the bodies tell the story. So we've closed below most of the volume. For me, I would consider that a market structure shift. So there's going to be some debate probably in the comments. Does the body have to close below? It depends what else is, supporting the trade, right? So if we just act on this, look at this, right? The bodies here, we take out the body volume. We don't take out the wick volume. That there's a rejection block. So we take that out. We push down. We inverse this bearish gap or this bullish gap here. We create this 2 minute civvy. And if we go back to the 1 minute time frame, we can see how price maybe reacts off that 1 minute civvy. So this is your opportunity now to go short. Why? Because we've now taken out some more liquidity here. We've just rated this internal swing high. So we're just taking out this buy side liquidity here, right? You can see that. Might make that a little bit bigger for you guys. We'll make that 16. You can see now we actually have a market structure shift on the 1 minute. On the 2 minute, a little bit different, harder to see. So we enter a short position and we go short right away here, maybe as you reject. Where do you put your stop loss? I would personally put it above this. What is this? That is an order block there. So again, this is kind of how I'd frame the trade, right? So that there is your bearish order block. Should price need to trade above that? It shouldn't need to, right? So as price is playing out, what am I thinking here? I'm thinking, okay, the stop loss is staying where it is. As long as we respect this and respect this, I'm still happy because we've also got this inversion fair value gap here, which should be acting as some kind of resistance. I'm going to make this a orange color as I usually do. And this is kind of what we're looking for, right? So where can we take this to? Let's assume you want a 1 to 2, right? You don't have to always go for 1 to 2s. Like all of this, that is like low hanging fruit. That would be a good spot to take a partial, in my opinion, depending on how many contracts you're in with. But there's 3 PDRAs now. Your stop loss, if you're in that trade, entering from here, your stop goes above this PDRA, this PDRA, and this PDRA. All you need is 3 PDRAs, and it should support your trade. So price does its thing. First TP, second TP, we sell off, right? We sell off. So that there is your first, I guess, silver bullet entry where you can use a civvy to enter. Now, you might be thinking, well, there's no sell side imbalance in the 1 minute, and that's fair enough. You might have been waiting for a retracement into this zone here. My kind of viewpoint on that there would be, okay, we've come up once, we've rejected. We've come up twice, we've rejected. We tried again, and we're starting to displace. Down here with these displacement candles, there's no reason why we should return back up here again. There's no reason why, because this is like a ceiling now. You treat this as like a ceiling. So again, really, really nice trade. sells off really abruptly. Now, notice how we've taken out this level of sell side. We're still in silver bullet, but you might be thinking, oh, can I take a long or should I just wait? Let me have a look here, right? So we've got that sell side liquidity point there. Let's go to the 15-minute time frame. Look what's happened with price. We've taken out a lot of these liquidity points and a lot of these lows. You've got to mark out now any other PD array that price could be bouncing off. So what price is tapping into now, these two down close candles, that is an order block. So we've taken out liquidity, we've tapped into an order block. You can switch between timeframes if you want to, like up to your 1 hour time frame. You can even go to the 4 hour time frame, depends how like fancy you want to get to it. And you can see here we do wick down into the 4 hour imbalance here. So maybe we might reverse. Maybe we might reverse, but when? We've got to wait for key time frames. So grab your Fibonacci, right? Go from this low to this high. We've tapped below equilibrium. We've also probably come into optimal trade entry, which is between 0.618 and 0.786. So pretty much what's going to happen here is when price comes down here, it rebalances into discount. It's a good opportunity potentially to look for longs. We're still in the silver bullet, but we have to wait until price action gives us something that we want. We know we've rated liquidity. We know that already. But here's the interesting thing, right? Is there any long opportunity right now? No. Is this a turtle soup? No. I've got to wait. I've got to wait. And what am I going to wait for? I'm probably going to wait for the next macro, because all we're doing now is continuing the sell-off. We need some more structure to form. Now, the next macro, let me draw this in a different colored line. So 1050, we're going to make this maybe orange all the way to 1110. So we're looking now for a trade in this time frame. Again, that's the end of silver bullet, but the setup can start to form in this time frame. So this is what we're looking for. Where do you target? You target any imbalance, any swing high here in a level of premium, right, which we'll talk about. So we're in a macro now. We're waiting for some kind of shift in structure, some kind of inversion fair value gap, something to show us, okay, here we go. That there is more than enough. That there is more than enough. What have we done here? We've created a market structure shift. So right there is your market structure shift. And we'll put that on the top. Right, your market structure shift. What can you do, right? There's many ways you can do this. You can enter a contract straight away as you have a shift. You can enter a contract once you shift past this point. But have a look here, right? Look at this. Price comes up. These two up close candles, or this one, that's your breaker block, right? We come up, we break past it. It's a breaker block. Price trades back down into it. That could also be another entry there, right? So breaker block entry, market structure shift entry. Price comes back down where? Comes back down into that breaker. That's an opportunity to go long. There is an imbalance here that you could also enter from. Now, your question might be, okay, well, there's an imbalance here, an imbalance here, an imbalance here, an imbalance here. Which one do I enter from, or where do I enter from? It's up to you, right? But at the end of the day, not every trade is going to come back down into this bottom fair value gap zone. It won't have to, potentially, right? So personally, what I like to do is I like to scale in my position. So say I go in with one contract here, then I can make a decision. Look at what price action's doing. Look at what price action's doing there. It's failing to displace any lower, and we're progressively moving higher. So one contract, maybe another contract here. And if we do decide to come back down, they're not entering potentially another contract, right? Whether you're trading MNQ or MQ, NQ, it's up to you, right? So that's kind of how I'd phrase the trade, right? Price is doing this now. You might be thinking, okay, what's going on? We're tapping into this candle, which is an order block, right? So again, we're just going to mark out all these PD rays. This candle is an order block. We're using that as a guest support. That's your busy. We don't come back. Notice that we don't come back into this bottom section. We leave that as a breakaway gap. Your trade would probably be looking something like this then. Your stop loss has to account for that. So it has to go somewhere like this. And maybe you want to target like a 1 to 2. Why would you want to target around that zone? Okay. Grab your Fibonacci, previous swing, right? Equilibrium, maybe you go to break even. This swing higher, maybe you take a partial because it's just above equilibrium. And then the zone is the optimal trade entry range. that could be a zone where we retrace. But if we don't, then we can target this original accumulation pocket. So that's your market maker buy model in action there too. So this is kind of what we're looking at. Potentially another opportunity to go long. All right, have a bit of a look. Imbalance, right? There's an imbalance right here, bullish fair value gap. And let's see what price wants to do, right? At this stage, we're sweeping this low. And that there's an opportunity for a turtle soup, right? Turtle soup entry. So we sweep that low. We come down, we raid liquidity. We tap again into that order block that I mentioned. Do we come into this imbalance again? I think we might just leave it, or maybe we just tap into it. So we revisit the same imbalance. It can get tricky trying to enter when the trade's already developed, because if your, say your entry model is to like enter right here, say you put your stop loss here for a trade, you're going to get stopped out. How many PD rays are supporting that trade? Only 2, a bullish gap and an order block. So ideally you want 3, right? So what you'd have to probably do is go below this one, because there's an order block and a bullish gap. That's what you'd have to do. If not, you wait. Like say you got stopped out here, then you can try again. Why is this play a better play? Why is this play a better play? Why is this one a better bullish gap than this one? Well, because we just took out sell side liquidity. So again, rating liquidity is an extra factor. This should be a protected low. Go for a long right here. Stop loss now below this low. And you can go below that fair value gap if you want to as well. So let me just fix this up for you guys. That's kind of what we're looking at, right? And what do you target? You target that if you want to. So let's play that out now, see what price action wants to do. Again, where did we enter? We entered here during potentially, but if you missed that, you could also enter here as well. So this is just kind of showing an extension of the Silver Bullet model, how you can frame the trade within those hours of Silver Bullet, and you can see regardless of whether you entered here or here, you still get that nice, that nice level. So that there is obviously the New York session. Let's do Mondays as well, right? If you like these types of videos, let me know, and I'll do a few more of these as well. So let me know. And if you want one for the PM session or for London session, also let me know as well. But let's do it for this session. Let's just go back. Where are we? Silver Bullet. We'll go back to roughly about here. The market's been very rangy, by the way. It's been very rangy in terms of price action. So we've been stuck in a range. If you go on the 1 hour time frame, it's like up, down, up, down, up, down. So start a Silver Bullet, end a Silver Bullet. People are going to ask probably in this video, can you enter trades just before, just after? Yes. I personally, if I was using the Silver Bullet, I'd use that as the basis. So if you can enter that time frame, great. If it comes just before or just after, that's also fine in my opinion, as long as the analysis is there, right? All right, so this example here, what happens? We come down, we raid this liquidity. Now, I'm looking at price. And I'm looking at it thinking, okay, where has liquidity just been taken? Right here. Where is the liquidity resting? Right here. What is at the top here? That is an original accumulation. This now could become the market maker buy model. Better yet, this swing low was generated during London session, which makes it time-based liquidity. So you raid time-based liquidity and then look at the reaction from that, right? Look at that. So there's many opportunities here to enter off inversion fair value gaps. There's a bullish gap here you could enter from too, but let's assume you wanted to enter in Silver Bullet, all right? Let's phrase a trade. Okay, let's have a look at what price action is doing. It's chopping around a little bit. That there could be a bullish gap that you tried to enter from. This one here, right? That there could be a bullish gap you try to enter from. Let's see if there's any other opportunities here for you guys, or if that's going to be the only one. Yeah, okay, it looks like that there's the only one. Now, the beautiful thing about this one is, again, we do raid this internal swing low. That is still a raid of liquidity, right? I'm going to make that a little bit thicker. It's still a raid of liquidity. We still raid that. So if you enter from here, let's assume you went for a long position. Your stop could be below this previous low because that's raid of liquidity. you've got a bullish gap, you've got an order block, and you've got a previous low that should be protected. That should be sufficient. You can target the extreme point, but you don't need to, right? You could take partials if you wanted to, but that's kind of what you're aiming for there at the top there. That is your buy side liquidity. So that there is your first kind of silver bullet trade. And we'll see if anything happens now, because once you raid this, you complete the market maker buy model. You complete the market maker buy model. So we'll play price out. We'll let it do its thing. All right, we've created almost, I think we swept that high just there. And we're coming towards the end, but we're entering a macro now, 1050 to 1110, which could lead to price action reversing. So we'll just see. All right, now having a look at this, how could you phrase a trade off this? Rate of liquidity. Let me zoom in a bit. Market structure shift. Let me draw that out. Swing low here. That's your market structure shift. I'll fix it up a little bit. You return to this very small imbalance, but guess what? It does exist still. There's still an imbalance there. That's your bearish imbalance, or a sell side imbalance, buy side inefficiency. There's also an inversion fair value gap, and you can go short. Now, if you're not confident yet, then you could even take a late or close proximity entry, and you can go short from here. Stop loss now could be above this high. Why? Because you've got an order block, you've got an imbalance, and you've got a SIBI. That's 3 PD rays. And that there, these candles are a very solid order block. We've got some down close candles, up close, down close. We shouldn't need to retrace back up there. That's already been filled, that imbalance. It shouldn't need to return. So then we end up selling off. Let's assume you took that entry right there. Could you take a partial here? Potentially. But if you want to wait a bit, you could wait a bit. And then what I'll be looking at here is, how far do we want to protract? Do we want to take out all this low resistance liquidity here? Could you hold on to potentially take that out? Here's another entry too, this SIBI or this SIBI, right? So if you missed any of those imbalances, potentially you can take an entry from here. But again, that's moving a bit later in the session. So it depends how far you want to extend like your silver bullet trading, right? Because you do end up taking out that liquidity. But if you want to stick strictly to silver bullet, then I guess your entry to go long would be here, and your entry to go short would be here. So you can see how you can use imbalances, you can use fair value gaps, you can use inversion gaps, you can use an order block. It depends how you see the market. You could enter before the macro, after your rate of liquidity, and again, that's what we've done here. Rate of liquidity, one more little raid there. And then once it happens, the macro happens, 1050 to 1110, we start to sell off. So hopefully you guys got something from this video. If you've got any questions, let me know. But until next time, I'll talk to you guys then.